Hello everybody, my name is Bobby Escalante. I work with US Bank. I'm a board member on the Development Network, and we're here with the lovely Mae.
Hello everyone.
We're here today just to kind of tackle a few issues around financial literacy and making sure that we're prepared for that home buying journey. So Mae's going to help me with that conversation today. How are you doing?
I'm doing great. Thanks for having me today, you guys.
Yeah, absolutely. I'm excited to be here. At US Bank we've been working really hard with within our communities that we work for to try to close a lot of the D&I gaps that we have. And when you think about what the American dream is, and home ownership has always been that pivotal notch when it comes to the American dream. It's home ownership. And we look at the struggles with the LGBTQ community and the discrepancies that are there. Studies show that gay couples are 73% more likely to be declined a mortgage than the heterosexual counterparts, right? So what can we do to try to close those gaps? And that's kind of what we're gonna be talking about today. If you look at stats, 35% of someone's net worth at the end of their retirement life is home ownership, right? It's equity in their home. And with that discrepancy, we're basically telling people, hey, you're only going to meet 65% of your potential, and that's not fair, right? So what can we do to try to close those gaps is educate people as much as possible and prepare them for financial readiness. So it's kind of what we're going to be talking about.
Awesome.
All right. How do you feel about those topics?
Well, first of all, being a 30-year-old gay man and drag queen, I don't own a credit card. So this is actually really, really great to learn, educate myself on this.
Well, talk about perfect timing, right? Then
Perfect timing. I'm so glad you invited me.
Awesome. Yeah, when it comes to home ownership, right, you want to think about three things. The financial documentation that you're going to need to be prepared for. We're going to talk about mortgage loan requirements. I think that's where a lot of people get, hit those speed bumps and roadblocks, and they get discouraged around what it is to require, when it comes to obtaining a mortgage. And then the last thing, people don't think about is the type of mortgage that fits them, right? There's so many different programs out there with first-time home buyers, FHA, and, it can get overwhelming for a lot of people. So understanding the difference in mortgage types is key too, and that's definitely the three things that are important for it.
So what type of mortgage is there? Like, I want to understand the type of mortgage people offer, because I don't know nothing about mortgage.
Yeah, no, for sure, and that's common, right?
Mm-hmm.
And when it comes to individuals, I think it truly depends on them, right? Like the documentation required and the mortgage loan that fits them is depending on the individual. Everyone's different, right?
Mm-hmm.
Speaking to a mortgage loan officer is going to get you, a bit better picture, right? And with the documentation, like if you're a traditional hourly worker, salary worker, you're going to want to have 2 years of tax returns, 2 most recent pay stubs, and 2 bank statements. Having those ready at all times is going to help you speed up the process. Now, when it comes to the proper mortgage for you, it truly depends on your situation, right? When it comes to the right mortgage for you, research is going to be key, right? Doing your research, getting all your paperwork together, understanding your situation. That way, you can have a good conversation with a mortgage loan officer to find something that fits you. But really, what I really want to dive into is the mortgage loan requirements, right? Those are the things where people really get stumped, right? And there's a couple of things that you want to consider, right? DTI, which is debt to income, okay? Your credit score, and then your verifiable assets, meaning how much money do you have to put down for a home, right? And how can you prepare for what you need to put down for a home? Debt to income is one of those things that people don't think too much about until they're ready to apply for a mortgage. But basically what it is it divides your debts by your net income, okay? And most lenders will approve a mortgage with the DTI of about 50%, but the lower the DTI, the better. So to put that into perspective, figurative numbers, right? Not realistically here, but say a person makes $1,000, okay? Their net income is $1,000. That's before taxes, okay? But I have a car payment that's $100, which I wish, but a car payment that's $100. I have credit cards for $50, and we'll say like student loans for $100. That's $250 in bills, right?
Mm-hmm.
So in that situation, my DTI would be 25%, right? Because my bills are $250, my net income is $100 or $1,000. We factor that as 25%. So knowing that most mortgage lenders, look at a 50% DTI, factors in the new mortgage payment. So in that situation, I would be able to qualify for a mortgage of $250.
I
right?
see.
That'll keep you in that 50%.
Okay,
range,
okay.
right?
I get it. I
Yeah.
get it. Because I didn't know nothing about like the mortgage, the percentage, how much.
Yeah.
So I'm trying to do my math in my head, like, do I own a home? And maybe not, because I don't make it out.
Well, here's the thing too that people don't realize. When it comes to DTI, certain things don't factor in there, like your phone bill, your auto insurance. That stuff's not going to count because it's one of those things where you can call if you don't want the phone service, you can call and cancel it and it's done. You can't call your creditors and say, hey, I want to stop paying. It just that doesn't work, right?
Yeah.
So when you think about your DTI, think about the things that are reported to your credit bureau, and that's definitely what's going to impact your DTI.
And so what if you had a good DTI but a bad credit?
Yeah, so that's where you're in trouble, right? So
Yeah.
you can obtain a mortgage with a 500 credit score, but you're going to be putting 20% down. The rates are going to be ridiculously high. Having a score about 740 and above is going to get you those prime rates, right? So when you think about your DTI and your credit score, they kind of go hand in hand, right?
Yeah.
Now, as it pertains to credit, we think about so many different things, right? You think about credit cards, you think about auto loans, right? We'll get a little bit deeper into that, but you definitely want to make sure you're having a good score that balances out your DTI as well.
I need to start getting my credit card going because I don't own one.
Well, let's talk about that a little bit. So, there's a couple of things we think about when it comes to establishing credit, right? If you don't have credit or, you're trying to establish, we have what we talk about is a secured credit card, okay? And those are where the borrower puts their funds up front. So most lenders, it's like $300 to $5,000. So say you want a credit card of $1,000. You put your own money up front, $1,000, and then the creditor will basically give you a credit card with $1,000 balance. Okay, so the reason why that's beneficial is A, you're putting your collateral up front, the funds, and your approval odds obviously increase when you do that. Two, secured credit cards actually report to credit bureaus twice as fast. So they help people build their credit twice as fast, right? And the wonderful thing also is, credit history matters. So you don't necessarily want to close that out. Say in a year, 18 months, you got your score to where you want it to be. You don't have to cancel that credit card. All you do is you call the creditor and say, hey, I'm ready for a traditional credit card. And what they'll do is they'll run your credit, and if you're approved, they'll transition it into a traditional credit card, and they'll mail you back your $1,000.
Okay.
So it's not like you're losing your money, right?
That sounds really good.
Right,
Actually.
exactly.
But with that security card, does it applies with do it add interest as well, or?
Yeah, so it does work as a traditional credit card, right? So you're putting the funds up front, and that is your limit. But it does work like a traditional credit card. So there are interest charges and stuff like that, and that's how they're allowed to report to credit bureaus and establish that credit. But when we think about credit cards and we think about interest rates, I want to make sure that we drive that point with understanding the difference of creating high balances for yourself or using it responsibly, right? So if I have think about everyday purchases. You're going to buy gas. Right, you're going to buy groceries, you're going to pay your phone bill, your utility bills, right? Those things are just natural purchases. Most people use debit cards for that type of stuff or their bank account, right? But a lot of companies, they offer, rewards for those types of purchases that you're going to be utilizing. US Bank specifically has a couple of products that offer cashback rewards or point rewards for those everyday purchases. So, you're kind of accomplishing three things. A, you're going to get points for purchases that you make. Two, you're building your credit, you're establishing your credit. And three, you're secure, right? If somebody gets your debit card, it's, they can wipe out your account and you're screwed, right?
Right.
It happens all the time, and customers come to us all the time like, oh no, someone got my account. But when it comes to a credit card, if something goes wrong, you call the credit card company, hey, this is not me, they'll report, they'll file a claim, they'll send you a new card, and guess what? They didn't touch your, your bank account. And the other thing too to think about with interest, right? We get so caught up in, creditors, credit cards being an expense, right, with interest and stuff like that. But if you actually pay the full balance before the billing cycle ends, you don't pay any interest. So A, you're reaping the rewards from the points, right, that you're using on these cards, whether it be groceries, gas, so you're getting money back and stuff for that. B, you're not paying any interest because you're paying it off before the billing cycle is. And C, you're secure. Right, so thinking about those things, it's just about managing it responsibly.
maybe it's time for me to open a credit card because
That's why I'm here.
I want to buy a house. I want to buy a house. I really want to buy a house.
Absolutely, and you know, getting there, it's making sure that you're getting those things in order, right? Credit cards, you know, are key to establishing that. You know, again, knowing the DTI requirements, right? And if you know, there are people out there with high credit card balances, and you know, that creates an uncomfortable situation to have to make a tough decision to what needs to be paid, and usually that stuff affects your credit, right? So. You know, if you're in that situation, I would always advise some sort of consolidation loan. You know, when it comes to loans, it'll lower the payments, right, which lowers your DTI, which we talked about. But it'll also help you pay it off faster because personal loan interest rates are about a third of what they are for credit cards. So if you're in that situation, look, you know, speak to a banker to see if there's some options that you can consolidate some debt and lower your payments, pay it off quicker, you know, so on and so forth. But yeah, credit and DTI, those are going to be the most important things when it comes to being prepared for your home. And then the down payment aspect, right? A lot of people are like, well, I don't have enough money, you know, to put 20% down. And, you know, that's a misconception. You know, actually the average amount in Sacramento, it's about $12,500 that's needed to get into a home. You know, that's the average assets that you need. So, you know, finding ways to get yourself in a position to have great DTI, good credit scores, and making sure that you're starting to plan for the future to save money. Those are the three things we really want to make sure that we bring home.
Okay, so I have a question with the mortgage. So for someone like me who don't have any credit at all, no credit card has never been open, but then I want to buy a house, but my mortgage, my DTI is good. Will I still be qualified for that?
It's rough without a credit score.
Oh, so it's really rough. So definitely get a credit card.
Yes, you're going to want to establish that credit. Yeah, if you don't have credit, you know, lenders, you know, typically will deny you for anything and everything. And, you know, you bring up a good point because a lot of people don't realize how important credit is until you need something.
Yeah.
You know what I mean? Or, hey, I need an auto loan. And you go to get a, you know, to a car company and apply for, you know, an auto loan. And like, well, you don't have credit. We can't lend you, you know, this. I remember when I first bought my first car, I had purchased a motorcycle, right? But it wasn't considered an auto loan per se. So I went to go get my first car, and they were, you know, going back and forth with me. I wasn't sure if I was going to get approved because they were like, you don't have auto loan experience, right? And I'm like, well, how do I get it if I don't have a car, right? But back then I was a lot younger. I didn't have credit cards. I didn't have other things. So the sooner you get involved with, you know, credit and establishing credit, you know, the better off you're going to be for that home purchase, you know.
Awesome. That's very good to know.
Absolutely.
30 years late.
Hey, there's never too late. You know, we get people coming in all the time of all different ages looking to establish credit. So, you know, the important thing is to have the conversation. You know, when we think about credit, you know, people get uncomfortable with those conversations, right?
I get very uncomfortable. Like, I'm scared of death. Like,
exactly.
I don't have that kind of, you know, I grew up in a small family, you know, very, a big family actually, but very poor. We grew up very poor, so, you know, my parents always tell us, don't go in debt, don't go in debt. Like, that's always been the biggest fear of mine with my mom teaching me that. So I never want to open a credit card. But I always want to own a house. I always want to, like, own things.
And they go hand in hand, right?
Yeah.
And the reality of the situation with credit and being uncomfortable, I think, you know, from my experience, the reason people don't talk about it is education aspect, right? We don't feel confident enough to know enough to be able to have a good conversation about it, right? So I think the more equipped you are with information, you know, the more fluid and comfortable you are having conversations. Like, you know, when I first started in the financial industry, I probably wouldn't have this conversation, but, you know, learning through things, going through things, and understanding more about finances, I feel like everyone should know this, you know. Before we started this interview, you know, we talked about how the education system, where, you know, there's a lot of opportunity to present these topics to kids at an early age, but, you know, unfortunately it's not happening as often as it could. So, unfortunately it puts us in positions at 30 years old and on to barely start catching up into these aspects, right? So, there's a lot of opportunity, and, you know, it definitely starts, you know, with being young and having the conversation. So the sooner we can have conversations with our youth, the better off, you know, our economy is going to be, and people are going to be in better situations to have home purchases and all that good stuff.
That's very, very good. I wish like they taught me that in high school.
I agree.
And top of that, like, I wish they made me my mom made me go to college. I was such a bad kid that, you know, being who I am, I was focused on getting the money because my parents not going to accept me for, you know, what I do anyway. So I'm just going to focus on the money. And that's always been me. I never thought about like credit card. I was so scared of debt, and now I'm like thinking, I'm 30. I need to get me a house.
Absolutely. You got to start somewhere.
Yeah.
And like I said, you're gonna buy these things anyways. You're gonna buy gas. You're gonna buy groceries. Why not reap rewards from it and do this? Do the everyday purchases and have that security. I mean, it's because the stigma of credit and interest and people think it being so negative. That's the outcome we get, right? But they're not as scary as long as you know how to use them, manage them responsibly, and pay attention to how much you're using, and don't overspend. That's where people get into trouble.
And you guys have people who walk people through that.
Absolutely. Our bankers are well versed in making sure that we're establishing these conversations to understand that, hey, I'm not just going to give you something to go willy nilly with, but hey, make sure that you're doing these steps to secure your future.
Awesome. It's very good to know.
Absolutely.
I might just open my credit card like tomorrow.
Well, I appreciate you taking the time to really have this conversation, because I think the more people we touch, I think the better off we're going to be. So that's really.
Well, thank you for. Is this ending? Is this about to end?
No.
Oh, there's more. Okay, good.
Unless it is, I mean, we can.
Keep going.
The only thing I wanted to talk about was savings afterwards.
Okay.
Planning for that. That's kind of my last talking point. I don't know if you want to keep going. Or
Keep going.
Okay. After you got the credit aspect in order and your DTI in order, we talked about that down payment, right? Where how we prepare ourselves for that. When we think about savings, we're in a consumption community, right? We always want. So a lot of people struggle with saving money and making sure that they have enough for that down payment. No matter how good your DTI is and your credit score is, if you don't have that down payment, it's really tough to secure that mortgage, right? Lenders also look for what we call cash reserves, right? If you have enough for a down payment plus maybe 2 or 3 mortgage payments that are there for you when you need them, lenders look at that as a good thing. You're qualified. We don't want to make sure that you're cleaning yourself out to try to obtain a mortgage, right? You still have a little bit of reserves, but how do you get there, right? I think it starts with having a plan. With anything, like understanding your credit, make sure you pull your credit report. You monitor that regularly. With anything, to get somewhere, you got to know where you're at, right? And know your situation. So with credit, same thing, right? Pull your credit report, understand it, pay off those past due balances. But it's the same thing with savings. They go hand in hand. You can't know where you want to go or achieve something without setting those goals and targets. So, set that goal, find out what your plan is, and then really establish a game plan. Check your monthly spending. Set yourself a budget, right? Try to be a little more responsible. I try to remind my customers that, home buying is an investment, right? And preparing yourself for home buying is an investment, right? Because it doesn't happen overnight. So saving is one of those things. Savings takes time, So setting automatic recurring transfers to your savings account, right? Out of sight, out of mind. So you don't have to manually put it and see it and I want to spend it, right? Yeah. So having that automatic transfers will prepare you for that. Participate in, employee retirement plans, 401k, stuff like that. That's going to set you up for your future. And then 2 things that I like to suggest that people don't really think about too often is disability insurance that policies that you can purchase, or preparing for the unexpected, right? Those are the things that people don't include in their plan. Mm-hmm. You don't know how many customers come to us like, oh, this happened, I wasn't expecting this. I've learned that life is unexpected. You know what I mean? And
it is, it really is.
Things happen all the time that we don't expect. So
like COVID.
Yeah, exactly.
Like COVID.
Prime example. We're in a situation where the unexpected happened worldwide. Not just our situation, but worldwide, right?
Yes.
And how many people do you think were actually prepared for this? Not many.
Not
a
lot.
Exactly.
Basically half of the world.
Exactly. So preparing for those those scenarios like that to happen is important to include in your plan. But absolutely, I think it's just being conscious, being aware of it, and making sure that you're setting your goals strategically, right? Not by by next month I want to have $1 million. It's not realistically going to happen.
Yeah.
So understand your spending, set those goals, factor in some of those unexpected expenses, and then you'll really set yourself up for success.
So for an average person like me, who wants to open savings, all of that, how many years do you think will be for me to be able to afford? I don't think I'm not wording it right.
Keep going. What were you trying to say?
So I had no credit, basically. I had no credit, but then I want to start saving because I want to open a credit card, and then by a certain year, I'll be able to afford a home. How long do you think for a person like me who started at the age of 30?
You know, I'd have to sit down and we'd have to go through a full-on
we have to
your
go through all
situation.
that. Okay.
But to be honest with you, it truly depends on, you know, how ready you are now, right? Everyone's starting point is different. So that finish line is going to be depending on where you're at, right? So some people are in a better situation to where they can make it happen in a few months. Some people who are, you know, like yourself is establishing your credit, that credit takes a minute to establish. It doesn't happen overnight. So first thing I would say is set a game plan to save for that secured credit card. Get that secured credit card. Establish that credit. In a year from now, when you're utilizing that credit card, you're paying off the balances and stuff like that, you're really building your credit up, transition that to a normal credit card, get your money back. By then you should, you know, you have 12 months in, 18 months in of saving a couple $100 a month, you're already putting yourself in a better position. So where you think about like how many years it's going to take or how long it's going to take, I think the important thing to think about is staying focused and, you know, think about your goals on a regular basis, because if that's where we get sidetracked, right? You know, we set this great plan and then a month or 2 months down the line, unexpected happens. And then all of a sudden we're thrown off track. But maintaining that strategy of, hey, these are the steps I have to take to achieve my goal of that home buying process. Remember, it's an investment. It takes time.
It is.
Right? So the first thing I would say again is saving up for that secured credit card, get that secured credit card, establish that credit, set your budgets in mind, think about what your spending habits are, prepare for the savings aspect, pull your credit report, right? Look at those things, see if there's any, like you said, you don't have any, you know, established credit cards, so you don't have any past debts or anything like that, so you're in a better situation there that you don't have to worry about collections and stuff like that because you know you're starting out. So for a person in your situation, it's actually easier to build that because you don't have credit. It's somebody who has bad credit that has to rebuild it that takes a little bit longer, right? So
so I have a question, another question. I have many questions.
Keep
so for someone like me, would you guys just offer me a certain amount to start off with, or
for a secured card? Well, the secured card, like I mentioned, that's up to you.
So
it could be $3,000 to $5,000. For us, the minimum is $300, the maximum is $5,000. But you're putting your own money down, so it's up to you on what you would like your limit to be. Most people, I'm gonna be honest, you know, most people who open up secured cards, they start with $300 to $500 just because they're just trying to build something, right? Trying to establish something. But we do every now and again have people come in and say, I want to put a couple $1,000s and open up a secured credit card. There is no limit per se when it comes to that because it's on you. But after a year and a half, when you transition that into a traditional credit card, that's where it's based on your income and it's based on your credit score. Okay, and that's where your limit gets set.
Awesome, I get it.
Close it up. Close it up.
How do I close it out?
Well, thank you so much for for doing this with me. I really appreciate it.
Thank you for having me.
Honestly, this has been a pleasure.
I've learned a lot, DTI. I'm getting credit cards by tomorrow. Buy me a house.
I'm here for you. I'm going to give you my number too, so if you have any questions or anything, I'll be here to help you.
Awesome. Thank you so much for having me.
Thank you.